Good morning. What is the secret to getting lower rates? Well, here's the clue: understanding debt yield. And when borrowers ask how to get a lower interest rate, they usually expect answers from let's work on your credit score or improve your down payment or loan to value. And those questions and items do matter, but in commercial and investment lending, debt yield often matters more so. So if you understand debt yield and structure your deal around it, you can materially improve your pricing, your leverage, and the lender confidence in the deal. So you may be asking, what is debt yield? Well, debt yield's a metric that measures how much cash flow a property produces relative to the loan amount. So there's a formula here, but really it's your net operating income divided by your loan amount. So net operating income, NOI, what you're bringing in, and the loan amount advanced. So if you're bringing in 500,000 after expenses, and we're able to obtain a loan for $5 million, you'd be getting a debt yield of 10%. And you really have to think about that from the lender's perspective is the point. And from this view, this really answers one critical question for them. If everything goes wrong, how strong is the income supporting this loan as a standalone basis? So if they have to take it back over is the frame. But why lenders love debt yield? So unlike DSCR or loan to value, debt yield ignores interest rates and property values, and it's really just a pure income to loan math concept. So that's why lenders use it. And it can be used to control their downside risk, and it can be used to compare deals across markets. But it can also justify lower pricing on stronger assets and vice versa, higher pricing on weaker assets. So a higher debt yield equals a safer loan for them, and also better terms for the borrower is usually how that impacts you, the customer. So how debt yield impacts your interest rate. And most lenders have minimum debt yield thresholds. And let's just give you a range of about three categories. So 6 to 8% means aggressive leverage, and you're going to see higher rates as a result. But if they're making 9 to 10%, you're going to see market rate pricing. And if they're making 11 to 13%, you're going to see best in class pricing in the most flexible terms. So somewhere in the middle is where you want to be. But borrowers who miss this metric often over leverage properties and wonder why rates are coming back so high. And borrowers who optimize debt yield are going to get rewarded is the point. So let's look at debt yield versus DSCR, debt service coverage versus loan to value. A quick comparison of the metric, what it measures, and why it matters. So DSCR is basically cash flow versus your payments, and it's rate sensitive. And LTV is loan versus value, and it's market dependent. And then there's debt yield, which is NOI versus your loan amount. And this is a stable lender-driven metric and analysis. But debt yield is the anchor metric when markets are volatile or values are uncertain. So how do you improve your debt yield and in turn get better pricing? So a couple of the ways are you can reduce the loan proceeds slightly. You can increase your net operating income through rent optimization, so value add type strategies, or you can remove non-income expenses, or structuring it with an interest-only structure or a partial interest-only structure correctly can improve the coverage. And this is where experienced mortgage brokers are going to create real value for you, our clients, and not by rate shopping, but by deal engineering from the backside. So why Medallion Funds focuses on debt yield? Well, at Medallion Funds, we structure loans the way lenders actually underwrite them. And what that means for you is that you have somebody who understands it from their perspective, but it also helps us match deals to the right capital stack. We can position the income on the property correctly. And we can also advise you if you're over leveraging a property that might be hurting your pricing as well. And lower rates aren't negotiated. They're earned through structure and presenting the request properly. So if you want better loan terms, start with better metrics and better representation. My name is Bill Rapp. Please visit my website, billrapponline.com. You can figure out how to get a hold of me. Love to talk to you about your situation and see what we can do to help. Take care. Have a good day.